Hey guys, how you doing? I'm Kent Tilley, and today we're going to talk about how exactly everything is taxed within your estate. We're going to get into how everything is taxed when you pass away, how to reduce probate in certain provinces, and we're going to talk about which provinces are actually the worst ones to die in. I'm talking to you in Nova Scotia, so we'll get into it right away. Before I get started in this example, please remember to like, comment, share if you like this video. It's the best way to help us grow as a company. We're just trying to get the message out there and educate as many people as possible, so we love it when you do that. Today what I'm going to talk about is actually a pretty wealthy individual, because I wanted to show you all sorts of different types of assets and what happens to them when you pass away. We're going to talk about a number of things except for small business stuff, and there's a reason why I'm leaving a small business owner out of this, because it's way more complicated. That would take like an hour's long video. There's things to do with double taxation within money coming out of the company, all these other things. It's way more complicated than the average Canadian individual, even if they are wealthy like this person. So one thing you need to know is if you're married, then you pass away, all your assets can just roll over straight to your spouse. There's going to be no taxable implications at that point in time. And something that I do want to talk about in a future video is the most complicated individual planning there is, which is blended family planning, because estate planning for them gets really tricky, because it could roll over to your spouse and then maybe your heirs won't get anything. So you need to really plan for that. And if that's the case with you, I suggest that you really think about working with an accountant, a lawyer, a CFP, financial planner, to get these things organized and have conversations about them, because it can get really ugly. And I'm also going to talk about how to avoid ugliness in this scenario, because some of these assets can flow outside of your estate directly to the beneficiary. But if you do that and you don't do it properly, then it can cause significant tax implications for maybe somebody else if it's not even. So I would avoid it unless you know that it's perfect, even though you want to save on the probate. So I'll just start with that. Now let's look at a whole bunch of assets. The last spouse remaining, they have a house. It doesn't matter what you bought it for. It's worth $1 million. That is going to go to the estate. You can't put that towards the beneficiary. It's going to go into the will, but it is going to be tax-free. Now everybody knows that RSPs, liras, RIFs are taxed at 100%. It's like they're sold the day you die, and all of that money has to be paid like it was income in that year. So one of the planning things that you're trying to do is reduce the size of your RSP before the day that you die. This can go either directly to named beneficiaries or to your estate. And this is the really risky one, to go straight to the beneficiary, because then the estate has to pay the tax, but the beneficiary just takes all that money and doesn't have to pay the tax. And then maybe somebody else is like, I have this house left over, but I have to pay all the tax on that RSP. If you tried to say one kid gets the house worth $1 million and one kid gets the RSP worth $1 million, and we're going to flow that outside of the estate, well, then the kid with the house actually has to pay all of the tax, and then there might be a fight. So I would try and avoid that. TFSA. And in this case, the RSP is worth $1 million. Kind of bad planning. They didn't get to melt it down as hard as they wanted to, but they died young, and it was just unfortunate. If you go to TFSA worth $200,000, that can go straight to the estate or directly to the beneficiary, completely tax-free. Love the TFSAs. They have $200,000 in cash. The adjusted cost base on cash is the same as the amount. It hasn't earned anything, so there's no tax to be paid on cash. Cash is just going to go straight tax-free to whoever because you've already paid the tax on it. This individual also has a stock portfolio worth $1 million, but the adjusted cost base on that is $500,000. So that means that there was a $500,000 capital gain, and the day that they died, it's like everything was disposed of, deemed disposition as it's called, and so the stock portfolio is sold, has a $500,000 capital gain at this time. Also owned a rental property, bought it for $200,000, thought it was like perfect. Nobody ever loses in real estate. Real estate always makes money. Turns out that it was actually worth less the day that they died. It's only worth $100,000 now after realtor fees. So you're not going to have to pay tax on the money like on the realtor fees. So once it's said and done, they sold it for $100,000. There's a $100,000 capital loss on that rental property. They also have a permanent insurance policy that has a cash surrender value of $250,000 and a face amount of $400,000. This one can go to the estate or a named beneficiary or beneficiaries. And the insurance, any insurance coming individually is completely tax-free. So there's $400,000 going to the estate tax-free. And lastly, there's a family cottage or cabin if you're in Alberta, cottage if you're in Ontario. They bought it for $100,000. Over the course of the years, they put in some improvements. They kept their receipts. They put an extra $100,000 into it. Has an adjusted cost base now of $200,000, and it's worth $1 million. So there's an $800,000 capital gain on that cabin the day that they die. Now, cabins are also the ugliest thing when it comes to estate planning because there's usually more than one child. Maybe one wants it, the other one doesn't. You have to pay tax on the capital gain in order to keep it. Otherwise, you have to sell it. And some people don't want to use it while others want it. So if you have a cabin, you really need to start planning this with your children to see what and who wants it and how that tax bill is going to be paid if you do want to keep it in the family. Otherwise, it can be really ugly after you pass away. So just to look back, we've got a house worth $1 million, RSP worth $1 million, TFSA worth $200,000, cash worth $200,000, stocks worth $1 million, but there's a $500,000 capital gain on that. The rental property had lost $100,000. The power policy is going to pay out $400,000 tax-free, and the cabin has an $800,000 capital gain. So the total amount of assets is $4.9 million. But the only ones that are taxable is the RSP. That full $1 million is taxable at 100%. The stocks, they had a $500,000 capital gain, so half of that is taxable. So $250,000 is going to be added on top of the $1 million from the RSP, minus the capital loss from the rental. So minus $50,000 because there's a $50,000 capital loss. And then there's the cabin with an $800,000 capital gain times 50%, so $400,000 of income on that, for a total amount of taxable income of $1.6 million on $4.9 million worth of assets. Not too bad. However, nobody is going to be happy with the tax that's going to be owed on this. So what I did is I put $1.6 million into the Ernst & Young calculator and looked at every province, and I'm just going province and territory, and we'll put the list on there of the average amount of tax that you're going to have to pay. in each province based on that. And then I'm going to show you just the highest and the lowest, which might make everybody decide to move to Nunavut and move away from Nova Scotia. So Nova Scotia has the highest average tax rate on $1.6 million of income of 51.75%. So this estate owes $827,983 in tax in 2024. Nunavut has an average tax rate of 42.30, so they owe $676,782 in Nunavut, which is a difference of $151,201 if you lived in Nunavut rather than Nova Scotia. I've been in Nunavut once. It's chilly, but nice. And there's a road called the Road to Nowhere. So anyway, I would suggest you check it out. Groceries are cheap up there, as far as I've heard. I think it's like $30 for orange juice or something like that. Okay, so now we're getting into the probate issue. So full amount, if everything went into the estate, that's $4.9 million. However, if you designated a beneficiary and said, you know, the RRSP, the TFSA, the insurance is going to be going directly to a beneficiary, and you plan this out properly, then in some provinces you can save tens of thousands of dollars in probate because that money went outside of the estate and just directly to the beneficiary. Otherwise, some of the provinces are going to say this is the value and we're charging you based on that, and not including the legal fees that happen here. So what I would also suggest is you find a lawyer that doesn't charge based on the percentage of your assets, but actually on the time that they're taking. They're charging hourly for this process, because just because it's bigger doesn't mean that they deserve to make, you know, 1.5% on $5 million or whatever the heck their rate is. Just pay them their $750 an hour and you'll save some money. So some provinces doesn't matter. Probate doesn't really matter. So it's going to be flat or the same amount in some provinces no matter what. So I'll just list those off first. In Alberta, you're going to pay $525 basically no matter what. Manitoba, I couldn't believe this, actually got rid of probate fees. I can't believe that. I don't think that'll last that much longer. Newfoundland and Labrador, $435. Quebec, all they have is an administrative charge, which I was surprised about too, which is $65. And all of the territories have just flat fees for this. So Nunavut, $425, Northwest Territories, $435, and Yukon, $140. So Ontario, BC, Saskatchewan, New Brunswick, PEI, and Nova Scotia are all places where you might want to consider some probate planning. However, like I said, there are risks if you don't do this properly. You're trying to save in probate, and you might cause more harm than good. So make sure that you do it right if you're doing that. So in Ontario, the max probate you're going to pay is 1.5%. So on $4.9 million, that's $73,500, and on $3.3 million, that's $49,500. So that's, you know, $24,000 worth of, you know, tax savings, I guess, when you pass away. But is it going to cause more harm than good is the question. BC, it's 6% up to $50,000. And then you got to, and then 1.4% over 50,000. So the max is 68,600, and the minimum you could pay is 46,200, unless you move to Alberta like a boss, you know. Saskatchewan's very high, 1.7%. Yeah, they're even higher than Nova Scotia. So Ryan will put the list of all of those ones on there and what you're actually paying. PEI is not too bad, 400 plus 0.4%. New Brunswick is 0.5%, which isn't too bad either. And then Nova Scotia is pretty strange with this one. So it's $1,002.65 plus 1.65% of the value of the estate for some strange reason. So you know what, Nova Scotia? I don't know what's going on here, but I've got a little bit of a bone to pick with you lately. Like, why are you charging everybody in every scenario so much money? I've heard your roads are not good. Like, we just talking to a couple from Nova Scotia today, and they're like, I don't know where our money's going. But at least in Alberta, we've got low rates and we have nice roads. So I don't know what you're doing. Anyway, hope you learned something. Thanks again for watching, and we'll see you guys soon.